Welcome back to another installation of What Are the Odds? I thought it might be a little bit interesting to take a look a little bit closer at the historical performance of the bond market, considering the current inverted bond market and really how extraordinary this year has been so far. What we're looking at here are the current bond yields. We have the 1 year, 2 year, 3 year, all the way up to the 30-year yield. Now, one very easy way to quantify this is to add up all the different yields together. So, for example, the 1 year bond pays approximately 4.5%, the 2 year a little bit below that, all the way down to the 30 year that pays around a 4.1%. If we add all those yields up together, it's a very easy way to compare it to prior years. So, for example, and this goes back to 1990, every one of these lines on this chart represents a different calendar year. The black dark line over here represents the current year 2022. And what it shows us is the progression of the total bond yields, meaning if you take the 1 year, the 2 year yield, the 3 year, all the way up to the 30 year, you add them up all together, and that's what we see here is the progression of the total bond yields over the course of every calendar year. Now, at the beginning of this year, 2022, adding up all these bond yields gave us below 10% altogether. Interest rates are very low. Well, currently, the total bond yields across all those different maturities comes up to, almost 30% altogether. We have again, 4.5% on the 1 year, 4.5% on the 2 year, etc. So we see a tremendous expansion, a tremendous amount of movement out of the bond market, because again, remember, as yields go up, the prices of the bonds actually go down. Taking a look at this from a different point of view, we can see here every single year is represented by one histogram bar, and it shows us the amount that the yields increased or decreased over time. So, for example, in 1994, the total amount of bond yields increased by about 51%. Take a look at the recession in 2002. The total bond yields decreased around 50%. They decreased more than that in 2008. That was a 2008 recession. 56% decline to the downside. 2009, they went up by about 55%. And of course, the current year 2022, we see an increase in total bond yields of around 240%. This is not only the biggest increase in bond yields going back to 1990, this could be the biggest bond yield increase we've seen in many, many decades. Taking a look at the blue histogram bars, that shows us the S&P 500 performance. And we can see over the long term, the S&P 500 enjoys on average, or I'd say about 7 to 10%, maybe 12% a year. In the early 1990s, 1991, I believe, we see an S&P 500 that was almost a 30% to the upside. And later on, the 1990s, we saw a tremendous amount of growth into the S&P 500, and of course 2002, 2001. The S&P 500 went down by about 20%, 25%. And then, of course, the 2008 recession, that went down as well. Currently, the S&P 500 is down over 20% for the year 2022 so far, about 23%. Now, the red lines, the red histogram bars, shows us the increase or decrease in the bond yields. Typically, we'd expect bond yields to move in the same direction as stocks, because in a good economic climate, stocks go up, and then the Federal Reserve obviously raises interest rates that will send bond yields up higher. And conversely, in bad years such as 2002, the S&P 500 went down and bond yields went down together. There's not a very strong correlation, but generally speaking, as we can see, especially in the big years like 2008, S&P 500 went down, and so did the bond yields as well. What's very interesting is this year, we see the bond yields again have gone up around 240%. During the same period of time, the S&P 500 is down over 20%. And this divergence, this disagreement, is something that's very, very unusual. This obviously is a result of the Federal Reserve's of the Federal Reserve raising interest rates to stem inflation, while at the same time the fear of inflation is sending stocks lower. But we're in a very unusual situation. Now, if we were to measure the relationship between S&P 500 performance and the bond yield performance, we'd label this as convergence or divergence. Convergence is agreement. It's when both markets go up or both markets go down. Divergence is disagreement, when they move in opposite directions. Going back to the 1990s, we can see the yellow bars represent the convergence divergence. And we have quite a bit of agreement between the two. In fact, what this shows us, the yellow bar shows us the S&P 500 performance minus the bond yield performance. So take a look back. This is actually 1995. Take a look back to 1995 on the prior chart, and we see here the S&P 500 went up over 30% at that point. The bond yields went down to some extent. That was 1995. Now, we look to see the year 2002, S&P 500 was down over around 24%. The bond yields, the total bond yields, were down around 50%. But typically we expect them to move in the same direction. Notice what's happened now. While the S&P 500 is down a little over 20% for the year, the divergence is enormous. That's that yellow bar moving down. That again reflects how the stock market is down where bond yields are up. Now, if we use history as any judge, we could say, well, we would expect to see some sort of regression, meaning that if stocks are going to go down, we'd expect bond yields to go down. If stocks or bond yields are going to go up, then we'd expect stocks to go up. Well, again, let's go back to the anatomy of the economy. What we're looking at right now, stocks are going down in the anticipation of lower growth, in part as a result of the high inflation. But right now, the bond yields are up a lot because the Federal Reserve is raising interest rates to combat that inflation. Maybe we won't see this in 2022. Maybe next year, if we do expect a regression to the mean and we expect more convergence or agreement between these two different markets, we'd likely expect to see maybe bond yields go down to match the stock market performance. We could expect also the opposite. Let's say we expect stocks to go up. But typically, stocks are a forward-looking mechanism. We expect stocks to go up in anticipation of future economic growth. And then the Federal Reserve is a lagging indicator in the sense that the Federal Reserve raises interest rates only after inflation has gone up. And Federal Reserve will cut interest rates only after inflation has gone down or deflation has emerged, a recession has emerged. So if I were to guess, that if we're going to see any kind of convergence, divergence, and any sort of regression to the mean, we would expect to see bond yields eventually to go down once inflation is under control, at least according to the Federal Reserve. But again, this is an extremely unusual year. I don't know if there's something we can deduce from this as far as any sort of stock market prediction or bond yield prediction, but I think it's important to note because it is such an unusual situation that we're seeing now. We hope this has been helpful. We look forward to seeing you back soon.